India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call from the CNBC-TV18 and the Motilal Oswal studio. First up from me and my co-anchor Rima and the entire team at CNBC-TV18, both people on the camera and the many more useful people behind the camera. Here's wishing all of you a very happy 2025. May you be healthier, happier, and have a fun-filled year. Happy New Year to you too.
Happy New Year, Lata. And it's good to be working on 1st of January because it's sort of like a harbinger of, things to come. So I'm excited to be here, we've been complaining that,
I'll reserve my views on that. I genuinely believe we are following the Gregorian calendar for everything. February 1st is, budget day. Or, whatever. We follow the fiscal year is April 1st.
If the markets are open, I'm happy to be here.
If they're open, I'm happy to, but I don't think we should be open at a time when nobody else is working and the queues are going to be practically non-existent and people have a right to enjoy. For better or for worse, I would feel very bad that young people are being dragged into the office. Maybe you're not one of them who lets your hair down, but I know a lot of people who do. And I would think that the government of India must seriously give this a rethink. I mean, I'm ready to go all the way to Delhi and make my case and say that this is not the way to insist that people have less fun. I'm not convinced at all of that argument. But anyway,
just wishing all our viewers a very happy new year. Wishing you a lot of peace, love, good health and happiness in the coming year. But let's get to the markets.
Oh, yes. Actually, unfortunately, I'm happy that I have something to say positive in terms of wishing people because the cues continue to be negative for both India and for all emerging markets. It's not just that the US markets closed with red ticks. The Dow was not, it was almost flat. But the Nasdaq has closed with almost 1% down tick. And the other, the currency yields, all of them are not very clement. In fact, the dollar index went all the way to 108.5. So it was a very strong finish for the dollar. Of course, it's a big finish, 8% higher even for the year. But the point is overnight as well, we have to come to terms with a much stronger dollar. As well, the US bond yields went up by about 5 basis points, 4.5758. We have seen 4.6 just a couple of days back, but still this is higher than yesterday. So all that does come into algo trading. When you see the dollar strong and yield strong, then money tends to migrate to those kinds of instruments. And that will explain why you saw the FPI number as well. We all thought thin trading last day of the year, but look at the huge FPI selling. Yes, it's matched by DII, measure for measure, rupee for rupee. But even then, the point is we are not getting the prop or the attraction from global markets. I want to just dwell a little bit on the macro data that we got yesterday. We get a bunch of data almost always on the last day of the month. And this time we had the core sector data coming in November. It is a modest 4.3%. The only thing positive to say for it is better than the October number, which was 3.1%. But otherwise, I think the bright spark over there was cement. Cement's done very well. And coal was next in line at 7.5%. Steel at 4.8 is not exactly spectacular. But still, let us call it close to 5%. The others are all very poor. Refinery products, crude, fertilizer, even electricity, all of them in very low single digits or even negative. In fiscal data that we got, November tax data, over there, the positive would be that tax growth, income tax growth is very high. Importantly, capex was fairly good for the month of November. I mean, it was about 20% higher than a month ago. But we have still not bridged the April-November capex. If you look at April-November capex, it is still 13% lower than April-November of 2023. So it looks like the government will not be able to reach its overall capex target. In terms of tax revenue, overall not very good. 0.5% higher. Corporate tax revenue is actually lower if you look April, November. But income tax has done very well. And that becomes important because that spurs consumption, hopefully. And GST number, I'm only taking CGST. That's not very relevant. We need the overall GST numbers. One hopes that is higher, but we have to wait for a few days to get that number. So growth signs look modest. You can't call them robust. And of course, auto sales due today, tomorrow will perhaps be the best lead indicator. What do you have for us?
Okay, let's just quickly recap once again the US markets, because Wall Street ended lower for the fourth consecutive session, but it was a languid, low-volume trade. S&P 500 down close to about 0.4%, the Nasdaq slipping nearly 1%, but it was a remarkable year for US equities and US exceptionalism shown. For the year, S&P 500 is up 23.3%. And 23 and 24 combined gives S&P 500 a 53% kind of a return. And this is the best two-year gain since the 66% rally that we had in 1997 and 1998. The Nasdaq, the AI-powered boom pushed up the Nasdaq index to close to about a 30% gain, though the Magnificent Seven accounted for more than half of S&P 500's 2024 return. And look at the way NVIDIA boomed. NVIDIA's stock price was up 170% in 2024. For the Indian market, yesterday was a flat finish despite the intraday recovery. The Nifty closed at 23,644, so still below our 200-day moving average. So resistance for our markets will be closer to 23,870, which is the 200-day moving average, going up to 24,000. On the way down, yesterday's intraday low of 23,460. So 23,460 to 500 should be the support or the markers you should have in terms of a trade. Flows, the DII's net bought 4,546 crore. The FI's net sold 4,645 crores. So pretty much evenly matched. But the FI selling in the month of December is nearly 17,000 crore rupees. And the total FI selling since the market made its peak towards the end of September stands at 1.85 lakh crore. Now, typically, January has not been such a kind month for the Indian market. So there is a seasonality associated with, January. And at least in the last 6 years, the Nifty has given negative returns in the month of January, ranging between minus 0.3 going up to 2.5%. And brace yourself for a roller coaster ride, at least in the first half, because lots of cues, auto sales, PMI numbers, quarterly business updates come through from banks, from real estate. So that should start trickling in this, starting this week. Corporate earnings, of course, the big one will be 9th of January, TCS, Trump swearing in, the Fed meet towards the end of the year, and first, union budget. So we're giving you cues till the 1st of February, but, it's going to be a very news-heavy, headline-heavy roller coaster ride for our market.
Oh, absolutely. I mean, it's extremely well put. Thanks for a nice wrap, Rima, of the things that are going to move January. January tends to be weak also because there are conflicting views about what will come in the February budget. So that has been historically one of the negative points. But I know some Januaries which were outstanding. And I think that was one of my first budget years, perhaps 1997, Vajpayee's year. It was a dismal finish, the 97 December, 98 in just about 13 trading days, we rose 25%.
Wow.
25%. Those days we tracked the sensex.
This is why I love anchoring with you, because Lata, you give us perspective and history, which we've never seen.
Okay.
So it's,
some advantages of experience. Okay. But it's important that, January tends to be difficult only because people discount the bad news. And usually we have very good Februaries, the post-budget rallies. Remember, so many of them. But anyway, one day at a time. Let's look at some very important advice and comments that are coming ahead of the new year. Sanjeev Prasad of Kotak Institutional Equities gives us the equity call of the day. He says 2024 was a year of two halves with solid returns in H1 and no returns at all in H2 for the market. He says 2024 returns varied from moderate large cap index to solid small and mid cap indices, while 2025 will likely start soft. Given expense of valuations, continued consumption weakness, a wide range of possible US domestic and global policies and outcomes, and an unsettled global situation.
Sanjeev has also announced some model portfolio changes. He says they reduce the weight by 90 basis points on ICICI Bank, allocate some to IndusInd Bank. They removed Britannia and reduced the weight by 150 basis points on United Spirits and allocate 30 basis points each to Dabur and GCPL. They also remove SBI Life from the portfolio and allocate the same to HDFC Life and ICICI Pru. Sanjeev says they increase the weight in Adani Ports and Cipla by 50 basis points.
Okay, that's useful advice to start the day and the year. But we have more. We have a global expert, Matt Orton, Chief Market Strategist at Raymond James Investment, joins us now. Matt, good morning to you. It's really kind of you to join us on New Year's Day when everyone is having a hangover after the party. But first up, a very happy 2025 to you and your family.
Year to you as well. We're still a couple of hours away from that here in the U.S.
All right. Okay. In advance, in that case. Okay. Well, let's help us cast our eyes over at least the first quarter of 2025. Do you think we're going to continue to see U.S. exceptionalism? I mean, dollars finished at 108.5 yesterday.
Yeah, I think U.S. exceptionalism is going to continue. That doesn't mean that other parts of global markets can't do well. What it does mean, and I emphasize this to clients, is that selectivity really, really matters. This is where you can't just own an index fund to get broad exposure to emerging markets or international developed markets to help diversify your U.S. exposure. You really need to be specific. And that's one of the reasons why I'm so bullish on India as kind of a satellite to a core U.S. portfolio. But thinking just broadly speaking about why I'm optimistic about the market, because I am going forward. I think we're going to have a higher volatility bull market in 2025. We're already seeing what that's going to feel like, I think, over the coming months. And in particular, as you highlighted at the opening of the segment, there's a lot of uncertainty right now that we need to work through earlier in the year. There's uncertainty with respect to geopolitics. There's uncertainty with respect to what the U.S. Congress is going to look like. We have earnings coming up. But the fundamental backdrop is still very solid. I think in the U.S., we're going to see continued strong earnings growth. I think we're going to see a resumption of earnings growth in India. And I think all of that provides a buying opportunity for investors on weakness. And that's what I'm encouraging clients to do.
Matt, since you spoke about geopolitical, in a message that Xi Jinping has given as his New Year message, he said no power can stop China-Taiwan reunification. That's quite a stern message. And considering that Taiwan is the epicenter of everything related to AI in Asia, how would you read this statement and what are the implications?
Rima, I think this just adds to the mosaic of uncertainty that we have from a global perspective, and it keeps investors on edge. But we've seen the saber rattling before. We've talked at length in the past about why I don't like China as a long-term investment and why I think it maybe is a tactical trade at best. But China has a lot of serious domestic challenges that it needs to deal with before I think it can worry about invading Taiwan or finding a way for reunification. And we're seeing those issues continue to play out. The government refuses to still implement a bazooka kind of fiscal stimulus package that's going to give investors and consumers alike confidence in the path forward. So I think China's a wild card, but I don't think it's a wild card from a geopolitical perspective. I actually think it's a wild card from a global inflationary perspective because we are all benefiting from China exporting deflation to the rest of the world. So I often ask myself, and clients ask, well, what could happen with China? I say if China's successful and they start to get their economy moving into a higher gear, I think that actually poses more of a risk to the long-term investment perspective because it's going to force central banks to maybe not ease as much as we're expecting. But that's not my base case. I think we continue to see weakness in China, again, a reason to India for emerging markets and remaining overweight in the U.S.
Now, I take your point. Macro disinflation coming out of China is very good for India as an economy, as the macro economy. But try saying that to Tata Steel. Bao Steel is selling, according to the Tatas, they're selling steel at $50 less than their own cost of production. Forget the Tatas. And likewise, the chemical companies will tell you that. So Chinese disinflation can really hurt at a micro level. So let me boil it down to stocks. Yesterday all day we were speaking about the winners of 24. Now the big winners have been these assembling companies, those who are trying to get into the global value chain. the Canes, Amber, Dixon, who are, assembling plants for iPhones and laptops. They're the best performers. Do you like them? And the other set of best performers have been the e-commerce companies, the Zomatos, Swiggies, all of them. Would you like this set? Would you pursue them despite their triple-digit gains?
Yeah, I'd be a little wary because of the triple-digit gains, but that's why you risk manage your portfolio, right? You don't let your winners become too large of a position, and you also try and diversify into other maybe secular growth winners, like some of my other favorite names, like a Mahindra, ICICI Bank. Those are long-term winners, in my opinion. But that push for supply chain diversification from a global perspective, particularly away from China, that's only going to continue and pick up even more once we start to see Trump tariffs unfold, which I think we're going to get a picture of what that looks like very early in his new presidency in January. I also think there's drivers in India itself, a push to the more manufacturing, increased manufacturing in India by Modi. I think that's going to also help a lot of those companies continue winning down the road. So focusing on domestic production, I think, is a really long-term, durable theme in India in particular. And it's also a theme I'm telling clients in the US to lean into, because reshoring is a very real thing that's happening. And so many industrial and machinery companies in the US are doing well as a result of that. So it all comes down to balance. So I think you can continue to hold those winners, but also look for areas of diversification, say in IT services, some of the tech consulting companies. They've done well, maybe not as well as many of the others, but as the rest of the world recovers, financials in particular, you're going to see that part of the market work too.
Okay, so for diversification, you're also looking at IT services stock. What else, Matt? And on IT, some of the global counterparts are trading at much cheaper and reasonable valuations compared to Indian IT stocks. Is there a preference? Because, one of the guests we were speaking to yesterday, and he says he would prefer global tech companies over Indian IT companies.
Yeah, I think when I look at a lot of the trends, say in Infosys, for example, I think you have to look into who their consumers are. And this comes back to that concept of selectivity. It's not enough anymore, I think, to just paint a broad brushstroke for an industry or a sector in particular. You really have to dive into the fundamentals. And so I think if you want to own some of the IT services name, number one, I want to see better free cash flow generation. But most importantly, I also want to see more visibility into the earnings trajectory going forward. And to me, a lot of that's going to be generated by asset management firms globally, as well as global financials that are leveraging a lot of IT services and Indian IT services in particular to help outsource and provide a lot of additional support, helping them integrate artificial intelligence into what they're doing. And I think you see that with a handful of Indian IT companies. So I think that continues to play well. And, you've seen a rally as well. I'll call it fintech more broadly speaking, but say a 197 that's got Paytm. They have more cash on hand after the PayPay sale of their stake. And I think looking at where those companies are going to spend money going forward is going to be important too. How can they help to invest to continue to see earnings growth, especially if they do get a better regulatory regime going forward? So there's definitely a lot of opportunities, but it's that whole concept of knowing what you own that's going to be, I think, very, very important to success in 2025.
Okay, well, let us not throw sectors at you. You build a model portfolio for us. Say for an ab initio investor, what would the picks be?
So I think, first of all, you're going to want to have a core overweight. If we're going to be a global investor, you're going to want to have a core overweight to the US. And I think owning even something as simple as a SPY or the ETF RSP, which is an equal weighted S&P 500 ETF, I think that gets the job done very, very well for the US allocation, because I think breadth is going to continue to play out. I think to hit your global allocation within India, I think owning companies like I'd mentioned before, I really like ICICI Bank to handle your financials and traditional banks. HDFC Asset Management is another name that is certainly worth keeping on your radar and having a stake in. I think Mahindra is the prime asset in the auto space. That is a name where you're seeing not only continued growth due to vehicle launches, they're in a very favorable space with vehicle launch, but they're also seeing growth in their farm equipment business, and they get the royalties from the other more diversified conglomerate, the Mahindra. So that's a name that I think hits a lot of different parts. I like Infosys, Tata Consultancy as well to kind of round out the IT services picture. And then on top of that, a name like Adani Ports as well, I think gets you some exposure to the infrastructure theme. That has sold off in sympathy with, I think, cyclical slowdown in India, as well as some of the research and the DOJ probe earlier this year. But I think that looks very interesting, especially if we see a re-acceleration in India moving forward.
Okay, yeah, and India, of course, has its eyes peeled on port and import-export gains. So, yes, take your point on port infrastructure. Thank you very much, Matt Orton. It's a pleasure speaking with you, and thank you for filling us with a bag of goodies for 2025. I hope you have a brilliant one yourself.
Great to join you. Thank you.
Okay, so that's the word coming in, still very positive. Just, yes, US exceptionalism continues, but that doesn't mean other markets will not have very good investment picks, and you heard that list. Well, what have we got lined up today?
Well, these are the corporate interactions that are lined up for you on the show. So first up at 8:35, we've got Peter Maguire of XM Australia joining in to discuss his outlook for commodities for 2025. At 9 a.m., we have Bhavesh Shah of Equirus Capital to talk about the primary market action in the year gone by and how things may pan out next year. At 9:20, Sameer Arora of Helios Capital will be our market master for the day. 9:30, Sunil Singhania of Abacus Asset Manager will talk about markets and the outlook. Following that, B. Bhaskar of Kim's Hospital will be chatting with us at 9:40. A little later at 9:50, Sanjeev Singhal of Mazgaon Dock Shipbuilders will join in as the Ministry of Defence signed a contract valued at nearly 2,000 crore rupees. And towards the end of the show, in our special segment, It's the Economy, Lata will chat with C.S. Shetty of SBI to discuss his outlook for the banking sector.
Okay, that's a long list of very important people. So don't miss, even if you are a bit bleary-eyed. We're going to go into a break, and here's the list of top stocks that are lined up for you, which are in the news. Plenty of them coming up for you. You'll definitely hear about gas stocks. I mean, after all, we've got a cut in ATF and gas prices. So all that are lined up for you. Okay, we're getting to our research team, which is standing by bright and early on New Year's Day. Guys, all of you, a very happy New Year to you. Winnie, let me start with you. Okay, only the two of you at the moment. Winnie, tell us, what are the stocks in your list?
Good morning and Happy New Year to you as well, Lata. Firstly, I'll start with the aviation names coming in. We have Interglobe Aviation as well as SpiceJet also in the aviation stocks in focus. ATF prices that have been cut in Delhi by 1,401 rupees per kiloliter, and now the new prices are at 90,455.47 per kiloliter, and this is in Delhi. Mumbai also the prices have been cut by 1,349 rupees approximately, and now the new prices are somewhere around 84,511 in Mumbai. Do not forget that for aviation companies, fuel cost accounts to around 40% of their cost, so big cost that comes in from these prices. Other than that, OMCs are going to be in focus. Why? We're expecting a bit of a red here. Now, 19 kg LPG cylinder prices that have been cut by 14.5 rupees. So the new prices in Delhi for this is 1,804 rupees. So a bit of a negative coming in on that front. Maybe that could then move on to the neutral side is what we're watching out for, because these price cuts happen fortnightly for these OMCs. Other than that, let's keep an eye out on Zomato and Swiggy, because everyone across India has been swigging last night for New Year's, whether it was party supplies, whether it was snacks, what they ordered. So what came in from the quick commerce side and food delivery platform, Blinkit saw the highest ever order in a day, highest order in per minute, most chips ordered, grapes sold in a day was in yesterday's trading session and yesterday's New Year day. Swiggy and Instamart too reported record volumes, surpassing last year's sales is what they highlighted, and they saw the previous peaks, which was Mother's Day as well as Diwali. They crossed that as well. So we're expecting a positive coming in from Zomato and Swiggy.
You know, so the reason why grapes was so popular, because I think, you know, if you eat grapes on New Year's Day, it brings you good luck.
Wow.
So there is some superstition. There is some superstition attached to that. But Vivek is now here with us for some more stocks in the news.
Well, good morning and wishing you and the entire team as well as our viewers a very happy new year. First up, quite a few stocks on the radar on the back of news flow. First up is my trip, like we highlighted yesterday. Nishant Pitti yesterday sold 1.4% stake out of the total 14.2% stake that he held in the company. This was done via block deal. The intention was to exit the entire stake, but only 1.4% was sold last in yesterday's block deal. The next stock on the radar on the back of order win flows is Kalpataru Projects. The company yesterday has announced that it has received projects worth a little over 1,000 crore rupees. This has been got both in the overseas as well as in the domestic business. YTD order inflows have now surpassed 17,300 crores. The order book well in excess of 60,000 crore at the end of Q2. The next stock on the radar is SJVN. The hydropower company is the one that is in focus. The company yesterday has announced that it has signed MOUs for multiple pump storage projects, and this is in the state of Bihar. So the company has committed to a total investment of close to 10,000 crore rupees in Bihar. Out of that, the main investment will come in the Hatida Durgavati PSP. Over here, the project cost is a little in excess of 5,600 crore. Daily peak energy is 6.325 million units, which works out to an annual peak energy of 2,308 million units. Levelized tariff is quite high, so that is quite positive for SJVN. Levelized tariff is 9.39 per kilowatt hour. Also have a look out for NCC, a smallish order win coming in, a little over 349 crores worth of orders that the company has received. This particular order has come in the building division. Order book very strong, over 52,000 crore at the end of Q2. Order inflow guidance that the company has given is close to 20 to 22,000 crore. This H2 implied ask is quite steep given the fact that H1 ordering activity was quite muted.
Okay, thank you very much for that impressive list. When you look at these micro data, you do get the feeling that capex is not bad at all. Look at the number of orders, SJVN, NCC. But here are some more orders. Is it Abhishek has a list, Ireda and Nugent Software?
Well, to begin with, they have come out with a business update. The disbursements are pretty robust over here. It's at 7,454 crores, which is up 67.2% on a sequential basis. Now, it looks like the tenure of the book has increased, and that's also aided the loan growth around this time at 36.5% YOY and close to 7% quarter on quarter. My calculation shows that disbursements to AUM ratio might have come in at 60.4% when compared to just around 29% in the previous quarter. With respect to Nugent, they have got various orders. One order is of 14 crores for 5 years for the credit automation services product that they offer. The other order is of 11 crores. That is for 4.5 years sub-knowledge and record management system. They have another order close to 15.64 crores for 2 years in terms of digital account opening, retail loans, ECM and collections as well. And then they have, last but not the least, one order nearly 21 crore for a period of 1 year for their remittance system business. Back to you.
Okay,
Thank you.
Quite impressive.
Yeah,
And
Nugent won
Ireda,
orders even earlier this week.
yeah,
Or maybe
and
it was last
Ireda
week.
is a renewable energy lender. So that means that again, like SJVN, means the power sector is still hungry for more funds and projects.
Here's a quick recap then of the top stocks. Stocks with positive news flow are Interglobe Aviation, Swiggy, Zomato, Kalpataru Project, SJVN, NCC, IREDA, Nugent Software. Stocks with negative news flow are the oil marketing companies and Easy Trip Planners. Now let's get to Manisha for a complete roundup of all the action from the commodity markets overnight. Manisha, was there any action?
Well, Happy New Year. Very less action, I can tell you, in the international markets, for most of the important markets shut today. But you know what? For the first day as well, when you look at the weaker volumes in the markets, we have seen some starting trends on the first day of the year. Crude oil prices, for one, after ending 2024 as a second year of decline, and we did see 3% of decline in 2024, but 2025 has started with more than a percentage point of gain right now in the Asian markets. Well, it is about strong China numbers, whether it has been about manufacturing data and factory activity. That seems to be defining the first day of action here. In other commodities, we have seen strength continuing in case of gold. 2025 was the best annual gain since 2010, and we've seen 2025 start the year with $2,600 an ounce on the higher side. Prices did gain 26% in the previous year, and the markets have seen some buying support continuing here as well. The other thing that has seen strength has been silver. We've seen platinum prices gain up on the first day. What hasn't seen so well is the natural gas prices. After posting best annual gains since 2016 and gaining by 60% in the previous year, 7% of a decline in the Asian markets is what we're looking at. So clearly some profit taking coming on for this one.
Okay. Thank you very much for that, Manisha. In any case, natural gas saw some big spikes, so perhaps some correction was expected. But we have an expert who will take us through all that. Joining us now on New Year's Day is Peter Maguire, CEO at XM Australia. Peter, good morning. Thank you very much indeed for joining us despite perhaps the overnight New Year celebrations. And here's wishing you a brilliant 2025 from all of us at CNBC TV18.
Thank you very much, Latha, and to the same to everyone there. It's a special place in my heart, you and certainly the CNBC team, Manisha, Rima. It's a pleasure to join you, and sorry about the cricket. We're 2-1, but let's say in the last test, it might be 2-all. So there we go, and Happy New Year.
Oh, thank you. We have put behind a 2024, which has not at all been kind to cricket fans, but more on that on another day. You can bring tears to my eyes. Well, perhaps a new guard is waiting in the wings, and the old guard will have to make way. More on that later. Tell us about, just about every commodity. First, let's start with crude. Are the big days over? I mean, China officially said that they have peaked off in terms of energy usage. So do you think that's, for an importing country like India, it's one worry less? We won't see it go beyond, say, $74, $75?
Well, I think a lot of things working through what we saw in 24 and building on what Manisha mentioned. In 25, I think we've got the President Trump presidency and what he's going to do as far as production. China, and as you mentioned, are they at the top end as far as consumption? What's going on from a global demand picture? Are we going to also see further strip outs as far as geopolitical tensions, Latha, and building that into the market? And then you've got the mighty king dollar running at 108. I mean, the price of the US dollar at the moment, 108.50 for the US dollar index. So stronger dollar, traditionally cheaper commodities. So that's the storyline at the moment.
So Peter, on the dollar first, where do we go from here, at least over the near term, to your mind? And what would be the key factors determining that direction?
Well, good to see you, Rima. Happy New Year. I think
Happy New Year.
Thank you. Couple of things. Has the US dollar got the potential to hit a 110 handle? Now it's at 108.50. It's been an enormous trade to the upside, US dollar against everything. The Aussie dollar's been crushed. You've got a 103 handle for euro. You've got a yen sitting at the best part of 158, 157. So do we see intervention from Bank of Japan? And I think that the overall trend at the moment, there might be a 25 basis point cut by the Fed in May. So I think the dollar's going to build over the next month or two. And I won't be surprised to take a 110 handle out for US dollar and maybe even parity against the euro.
Okay. Parity against the euro. Okay. I think euro fell 8% this year. I think yen fell about 11%. So yes, it has been a period of dollar strength, but you think 110 is possible. But then it peaks off, you think? Could we see it a sharp retracement? Or because Trump looks like such a binary event, would it peak off and fall substantially from there or just remain strong for 25?
I want to see, Latha, I want to see how President Trump, the first 90 days, like anyone, a new CEO coming in, a new board coming in, he's got it's hard to keep up with what he's actually doing because there's so many moving parts to this. And as the chart tells the story, you've seen that yen. So there's been incredible volatility across the whole currency complex over 24. And I think you're going to see a build in the sense of US dollar because if you're not seeing a rate cut, and that's what they're penciling in, being in May for 25 basis points, then I feel as though it's going to be one-way traffic for US dollar, at least for the first quarter. So strap yourself in. I think it's going to be volatile, and I don't think it's going to be short of surprises.
Okay. Well, actually, the rupee has fallen the least. Just a word more. Yes. Peter, I wanted to ask you about base metals. That impacts us the most. So will the Chinese disinflation keep base metals cheaper? If you can tell us, copper, aluminum in particular.
Well, if I look at, first off, the likes of iron ore, Arthur, you're running at $100 a tonne, which is very, very soft pricing when you're thinking of what it was, that 180 level. Copper at about 87.50 at the moment. Aluminium's had a bit of a run up, and so is zinc, and so is tin. So we've just got to see, again, the appetite coming from China. You've got to see internal demand and, of course, the global demand for these finished goods. Are we going to see what's going to happen as far as tariffs being introduced? President Trump's key mantra is tariffs. So what impact is that going to have to the likes of China exporting all of these metal-ended products across certainly to the US and certainly across the world?
What about crude prices, Peter? In 2024, we saw Brent crude prices slide close to about 4 to 5% on the back of weak Chinese demand, which weighed on the oil demand. For 2025, at least in the first half, what is your forecast?
I think it'll be softer from here. I think first off, again, dollar, unless you see something dramatic happen from a geopolitical standpoint. So if things were going to escalate, then that's an uncertainty that just wraps across the whole complex. But I think that as far as dollar up, crude prices softer, President Trump going to increase production. So where's that increasing production going to go into the market? It's going to be cheaper prices, one would think. So it's going to be good for consumption and good for the consumer. I don't know whether it's got a sub 60, but I feel as though the mid 60s are going to be the home for pretty much crude leading into the next.
That's a headline. Peter, coming from you, that's a headline. If it's going to be mid 60s. So your range, what would be your range and your average?
I think I've got to go to 65 as the starting point. I mean, you're at 71 for WTI at the moment. Lather, you're at 74 for Brent. But I think you're going to see softer prices. I feel as though the Trump administration wants softer prices. They want to cut in the sense of from an inflation standpoint and increase production. So that's going to be cheaper prices. Okay. The other side of it is, what does OPEC want to do as far as their maneuvering? And we've just got to work through that whole process. And that's why I'm saying the first 90 days are going to be critical to really review.
Got that. Softer prices. I like to hear that word because we are consumers. What about gold finally? That outstanding performance in the earlier part of the year of 2024, does that continue? What are your range and, again, an average?
Well, I wore the handkerchief for a reason. I think it was just extraordinary what we saw in 24. Manisha made reference to it as far as 26% It's just absolutely mind-blowing, and so is silver. So I feel as though that momentum will continue as far as there it is there. Boy, that's just incredible numbers. So you're going to see, again, I think 3,000 is going to be the strategic point. Gold is sitting at 26.50 at the moment. Silver's running at the best part of 29.25 an ounce US. So I feel as though silver's got to hit that $40 potentially in 2024. That's what 2025, I should say. That's what many analysts are calling. And of course, gold at 3,000. Let's see then. Let's hold our breath and just see whether it materializes. But I feel as though it will.
Okay,
Peter.
3,000.
Peter, thank you very much for joining us today. Wish you a very happy new year. And we'll be watching the next test very closely and cheering for India. Thank you once again. We'll slip into a break. But as we do that, as we step into 2025, CNBC TV18 is asking some key questions. So how will the Nifty perform in 2025? What are the sectors and themes to bet on? Will the faltering GDP revive? Will the RBI start cutting rates? We'll ask the experts for you, so stay tuned for the most comprehensive market poll coming up at 9:20 a.m. today.
Welcome back, and it's that time of the morning when we will have an expert guest joining us to parse the news that we have got overnight and to help us pick stocks for the day, for the week, for the month, for the year. Joining us now is Devin Choksi, Managing Director at KR Choksi FinServe. Thank you very much for joining us, Devin, and here's wishing you a very happy new year from all of us, me, Rima, and the entire CNBC TV18 team.
Thank you, Lata. Thank you, Rima. Wish you all very happy 2025. And we pray God that this year brings a lot more prosperity that we will ever enjoy in our life.
Devin, keep your WhatsApp messages coming. I mean, they're extremely encouraging. I enjoy those. Okay, let's start with the markets now. At this point in time, how are we poised, do you think? The year we thought we would have a 20% gain. But if you looked, as many people have pointed out, from June to December, we have not gone anywhere. We remain at that 23,600 mark. So has the time correction come? And now the stocks will build up? Or is there more of the time correction left?
So, Ratna, the understanding is that on one side, we have got plenty of new IPOs which have entered in 2024. And probably the entire market segment got busy with this number of IPOs, including the institutional investors with the retail investors. Everybody seems to be, I think, overly busy with IPOs. Because these IPOs probably have given them the faster return than probably, I think, the frontline stocks would have ever given to them. And that is one of the reasons for which significant part of the activity has shifted towards it. When we looked at, I think, about 80 odd IPOs study that we did, and out of which I think somewhere around we made recommendation, we found that I think average 40 to 45% kind of appreciation has been produced by IPOs in the listing times, I think post-listing times. So certainly those who invested pre-IPO, those who invested as anchor investors, those who I think started buying after listing and I think exiting after the lock-in period is over, they made phenomenal gain. This could be one of the reasons for which I think our market remains subdued as far as the frontline stocks are concerned. Frontline stocks, nothing wrong with the fundamentals as I see it. I think most of the companies have shown the performance, and at the same time, the valuation-wise Nifty 50 stocks are today quoting at around 20 or below 20 PE. Historically, it has been also seen that I think whenever the stocks have gone below 20 PE, I think the reasons have come from everywhere, and probably I think the market has started correcting or re-rating thereafter. I believe that I think that's where probably we are looking at 25. In 2025, probably you should be seeing a smarter rally in some of the large cap stocks, which are languishing currently at a lower valuation, but promising to produce better results going forward in these quarters as well as in subsequent quarters.
You know, Devin, talking about large caps, Reliance Industries slipped 5 to 6% in 2024, and it's only the first time in the last 10 years that Reliance Industries is giving you a negative annual return. So after having a subdued return last year, would Reliance Industries be one of the large caps you would bet on? And there's also talk about the Jio IPO.
Yes, I think that's more important. I think the clarity on the future listing of the Jio platform as well as the Reliance Retail has been missing. And that probably, I think, checked the patience of most of the long-term investors, those who remain invested for a very long period of time. I think they haven't been finding that clarity coming from Reliance about when they would like to separately list these companies. Having seen the Jio platform reaching the annualized revenue base of 120,000 crore and EBITDA base of 60,000 crore, it is naturally expected that I think this company goes into a separate listing mode and provide the unlocking opportunity to those investors who want to unlock, I think, their investment as well. So from perspective of, I think, looking at this particular aspect, maybe the company hasn't delivered, and that's where probably some of the long-term investors, particularly the FIs, have exited the counter. That is what we gather. Maybe I think corrective course will happen in 2025, as I believe. And I think these two companies, Reliance Retail as well as Jio Platform, both these companies should be separately getting listed. And that's where probably unlocking of the values should take place for Reliance. Maybe patience is being checked at this point of time.
Okay. Well, to be fair, Rima and Devin, even in the US, the Dow has done only 12% this year. It's the NASDAQ which has done 28%. So it is like, if you remember, Devin, you and I were there to cover 2000 as well. It was all IT stocks. At that time, of course, it was the ICE stocks, and then we had some crazy valuations in the internet stocks. So this has been, as you pointed out, the magnificent 7 year, and therefore the smokestack stocks haven't done well. So, you know, with that backdrop, Devin, build a portfolio for us. What may be the winners of, if you're building for an initial investor, how should the portfolio look?
So, Lata, I think to us, the things remain, I think, pretty simple, not very complicated. We believe that some of the large cap companies, which are producing the larger part of the profits also in the entire listed universe, they are the ones who are available at the valuation which is compelling, which is attractive. And that's where we believe that I think larger part of the money should flow into. Maybe I think one would talk about companies like Reliance, one would talk about I think some of the banking space, corporate banking companies, even large NBFC companies, including GeoFinance. Some of these companies have significantly large amount of deep value into them. And we believe that I think these are the companies who could possibly give you faster and better return in 2025. As much as I think we are seeing it, I think the profit performance of these companies are not going to disappoint. On the contrary, I think it is going to probably sustain and surprise on the upside in subsequent quarters. So we believe that I think the some of the large bank and BFC companies would be the right choice. Maybe if we start getting some positive news pertaining to the war-related situation between Russia and Ukraine, in my viewpoint, I think some of the metal commodity companies will probably have reason to go up, and that could be a contra-buy opportunity. Also, because of the fact that demand would increase from the global side as well, apart from India infrastructure story. More importantly, with the mixture of energy cost, I think which is along with renewables, which is giving them some amount of tailwind from a profit margin. I believe that I think metal commodity companies could be another choice of companies which one could look at. And I think most importantly, renewable play, wherein the ancillary companies who are basically catering to the larger part of the power generation or power distribution activity, they are the ones who could possibly give you the opportunity to rally further, grow further, and make your portfolio gain further.
When you say ancillary, you mean power ancillary companies, right?
That's right, power ancillary companies. Yeah.
Okay, because that's what we were showing. Okay, then we got you right. Yeah.
Devin, sorry, did you say metals also?
That's right. Yes, I think we remain distinctly positive about the possibilities of metal commodity stock going up because we believe that I think the demand scenario is going to improve from here on.
Okay.
But dollar's on the rise.
Yeah, there may be, I think, a contradictory situation for a particular quarter or so. I'm not thinking that I think this is going to be a permanent feature. Maybe the markets have the habit to adjust over a period of time. So I think one will have to look around for the opportunity on a contra-buy basis as well.
Okay. We have a few more questions. Devin, may I request you to go and catch a cup of coffee while we take a break and come back and speak to our technical experts as well. We are not done with questions for you. Quick break, technical experts thereafter. Welcome back. It's that time of the morning when we are going to get to technical trades from our experts, Mitesh and Sudarshan. First, Mitesh has joined us. Good morning to you, Mitesh. And here's wishing you a very happy 2025.
Good morning, Lata. Wishing you, family, and the CNBC viewer family and the CNBC family at the studio. All of you wishing you all a very, very happy and a very blessed 2025. Coming to my indexed outlook,
Yes.
I have been maintaining some kind of a ranged bias, but keep a watch on 23, 550, 560 zones. We are likely to open around those levels as the GIFT Nifty is indicating. And if we start dropping below that, then good chance that we'll retest the lows of 23, 350. So it's mildly negative, but in case we don't see a follow through post the gap down opening, then we go back into the contracting range, which means that for the day we would have made a low around 23, 550, 560 zone. So I'll watch that level very, very closely.
Sorry, once again, what's the level you would watch?
23, 550 to about 23, 560. And on the Bank Nifty, I would just want to add, yesterday we hit the 200-day average and bounced back from there. So yesterday's low, or rather 50,600, 50,550 zone is a very critical zone. A bigger decline would shape in case we start breaking below that.
Oh, right. Okay, we'll keep both those in mind. Sudarshan has joined us. Good morning to you, Sudarshan. And here's wishing you a brilliant 2025 from all of us at CNBC-TV18.
Yeah, good morning, Lata.
Okay, well, let's get to the index strategy for the year. I'm sorry, for the day and for the near term. What would your Nifty targets be?
But I'll start with the year. It does appear that we are in a correction, as we all understand. And once a correction comes to an end, then the markets usually build a base. That takes some time, maybe weeks, maybe months. So for the year, I think somewhere around the second half of the year, the Nifty should see real upside action, by which time all the corrections, all the base building will be over. That's only an anticipation. Obviously, no one knows what exactly will happen.
Yeah.
For the short term, we are in a downtrend. We broke 23,600. That support level was broken, and I suggested step aside. Now, with gap downs, it becomes very difficult to go short after a 150 point gap. And in any case, a correction is difficult to short in the first place. The best way to trade in a correction, once you realize that we are falling, is to step aside and not trade the indices, focus on the stocks.
Okay, that's a fair point. Let's get to the stocks then. What are you watching today itself?
Well, I'm watching 4 mid caps, and all 4 of them are for buying. The idea is that, we keep on talking about buying on dips. So these are the dips. And if the stocks are outperforming, then adjust the stop losses and consider going long once the market stops falling. Britannia is the first one. My initial stop is 47.20. Escorts is a buy with a stop under 32.50. Godrej Consumer, another from the FMCG pack, which usually outperforms in a decline, is a buy with a stop under 1,060. And finally, from the IT pack, Syngene is a buy with a stop under 840.
Okay, it's good to hear a buy on Godrej Consumer as well, because that company had rattled us a bit with their bleak Q3 forecast. Well, Mitesh, what are the specific stocks you're looking at?
So, contrary to what Sudarshan has, I have more of sell calls.
Okay.
I have a sell on ICICI Bank with a stop at 1296 for targets of 1250. HDFC AMC, I think, is sitting right on the weekly pivot of 4180 and it's close about 15 odd points higher from there. So if it breaks 4180, 4175, take a short here as well with a stop at 4221 for targets of 4050. A buy on Balkrishna Industries for targets of 2990 and a stop at 2875. And finally, a sell again on Ambuja Cement with a stop at 543 for targets of 515.
Okay. Well, Sudarshan, since you are on buy mode, may I ask you whether you've looked at Nykaa, Zomato? I mean, usually they're excited around the new year, especially Zomato. Any of these stocks, is there a buy call?
Not for Nykaa, absolutely not. But for Zomato, I think so. It's a stock that should give a steady return. So it's a buy on dips.
Okay. Well, thank you very much, gentlemen. We are going to come back to you closer to the opening time at 9:10. For the moment, it's a break. We're going to come back. We will have the pre-opening rates with us, the first rates of 2025. We'll also have a guest, Bhavesh Shah, the Managing Director and Head of Investment Banking at Acquirers Capital, joins us to discuss the fundraising frenzy we are seeing on the IPO street. Stay tuned. We are back.
Welcome back. No cues to take from the Asian markets today. They're shut on account of New Year celebrations. But the GIFT Nifty should come up for you on your screen. Monday was a tough session. Yesterday, there was an intraday recovery. We closed flat. And the GIFT Nifty is suggesting the implied open is now down close to about 75 points. It's time now to get a handle on a few futures and options trading ideas. Chandan Taparia, derivative and technical analyst at Motilal Oswal Financial Services, is with us on the show. Chandan, thank you for joining in. Clearly there is no holiday for us, for the likes of you and me. But how would you approach trade today and what would the strategies be?
Good morning. Thanks for having me. Wishing everyone Happy New Year. And we believe that 2025 is going to be a fantastic year. However, it may be more of sector and stock specific, but we have to understand and take the next leg of rally to generate alpha in life. So looking at the index first, we witnessed some profit booking in last couple of weeks, but the good part is that supports are intact at lower level. 2-3 data internals are supporting that lower zone could act as a bargain buying level. FI's long short ratio has come to 12-13%, which might provide some recovery, but it needs to hold beyond 23,850, then only the stability will be big. So as of now, we need to play the broader range in between 23,300 to 23,850 marks. Looking at the Bank Nifty index, it also witnessed some profit booking decline, moving in a narrow range with capped upside. But multiple supports are visible at 50,000, and this index is moving in a rising channel from last 2.5, 3 years. So now looking at the selective stocks, first that is buy on lower slab. We have positive view on the most of the pharma name. Nifty Pharma Index is doing well, and Loras Lab has the strongest name apart from Lupin, Ipca, Glenmark, Divisley. So recommending to buy on Lupin as it completed a pole and flag pattern, which has bullish implication. Rollovers were better, so one can buy with support of 593 for an upside target towards 632. Second trading idea, that is buy on Muthoot Finance. Price has retested its breakout zone, and consolidation breakout is giving the fresh leg of rally, moving in a rising support trend line, holding well to key moving averages. So one can buy with support of 2085 for target towards 2235. Last trading ideas, that is United Spirit. We believe that high speed will continue at the beginning of the new year. Has been making higher base. Momentum could continue. One can buy with support of 1600 for an upside target towards 1700 zone.
Okay. Thank you very much for all that. And Chandan, here's wishing you on my behalf as well a very happy 2025. Okay, so that's the word coming in on F&O trades that you can have for the day. And now, just a word on how the opening trades are panning out. It's starting off in the green. The implied Nifty close was actually in the red. But it's opening in the green. Let's wait for it to settle down. It's a bit too early to speak about any of the trades just yet. It's a little confusing. I mean, a DLF is down minus 1%, ONGC down 1%. And you have some, 2.5% on some other stocks. It's okay. I think we'll wait for the trades to settle down and use that time to discuss the IPO market, to discuss the fundraising. In 2024, actually, Indian companies raised a whopping 3.5 lakh crore rupees across 438 issuances. Bhavesh Shah, the Managing Director and Head of Investment Banking and Acquirers Capital, joins us to give us an idea whether the IPO frenzy continues. Well, Bhavesh, good morning. Thank you very much for joining us. A very happy new year to you. And tell us if the happiness continues for the IPO market in 25 as well.
Good morning, Lata, and wish you all a very, very happy new year.
Thank you.
I think this year of 2024 has been exemplary for capital raising. I think because of 2-3 factors. I think the markets, of course, have been buoyant, but I think it's because of the domestic liquidity which has been coming in. We had situations where we were always dependent upon FIIs, but, the last 2 years, we have seen domestic inflows, coming in, and we're no longer dependent upon the FII inflows for the issues to happen, which used to be very cyclical. So we would have IPOs happening maybe 1 year in a 3-year time frame, but now we might have see more consistent IPOs happening going forward. So I think overall, I'm very positive about the coming year. I expect the flows to continue, and I'm looking at even on the supply side, the companies which are now coming are fantastic businesses, fantastic promoters, good business models. And they will want to raise capital, and there will be investors who will be wanting to invest capital. So I expect this trend to continue. Obviously, there will be risks involved, but otherwise, I think that the way we're looking at it right now, the trend seems to be very positive for this year as well.
In the previous cycles, we used to always say that when IPOs start listing at a discount, that clearly means companies have gotten greedy and the IPO frenzy has brimmed over. Now we are not seeing that actually. We're seeing most of the IPOs make money even on listing day, even the ones that listed this week. So do you think, therefore, just the change of the calendar doesn't mean the IPO season is over, because companies seem to be behaving responsibly?
Absolutely right, Lata, and so that's a great observation. Why I think, what's happening here right now is the domestic institutions who are becoming more and more flush with funds, they are incorporating more and more stricter processes for their investment decisions. Gone are the days where you can actually call a fund manager and you can the fund manager himself takes a call to put in the money in an IPO. But now there's a process where the analyst gets involved, the consumer gets involved, the director gets involved, the IC gets involved, the fund manager gets involved, and it's a joint decision because now the mutual fund industry, for example, is managing more and more money. So I think with that, the amount of diligence the institutional investors are doing on each and every IPO, A, to select which IPO to invest in, and B, the pricing. The pricing discipline is fantastic. I think I must compliment the mutual fund industries for that. And I think the promoters also, on the other hand, are realizing that IPO is not an event which has to be milked for getting all the valuations upfront. Their promoters are now viewing this opportunity or an event of an IPO as a stepping stone for value creation in a long-term journey, and it's just a milestone in the company's IPO in the company's lifetime. I think a combination of all these factors have resulted in people or the investors making money, and which is in fact one of the major reasons I also believe that it lends credence to the optimism that I have in the coming year as well. At the moment these investors become reckless and their returns start falling, that is the start of the fall of the market.
Bhavesh, hi, morning. Rima here. So tell us, how are FIIs approaching when you go to them with a primary issuance or IPO as anchor investors? Because the FIIs have largely shunned the secondary market, buying in the cash market. So when you go to them, with the prospective IPOs as anchor investors, are they interested in it? Have they been? So of the inflows, what percentage of it, for instance, has come in from FPIs?
Hi, Rima. I think, what's happening is, as I was saying earlier, the FII money continues to be cyclical in India. They are there for a few months, they are not there for a few months. And depending upon their investment, sentiment, whether they're investing in India or not, their appearance comes up in the IPO. But what we are now seeing is the domestic inflows are becoming more and more stronger and stabler for an IPO to happen. We used to have a situation many, many years ago where the domestic investors will look up to the FIIs and set the price, and they will kind of dictate whether the IPO is happening or not. Today we are having a situation that FIIs are looking up to domestic, whether they are investing, what is the price they're investing, and then we'll be the followers. That's the general trend we are now seeing. I'm not saying that happens every time, but compared to what we used to see earlier, we are now seeing more domestic. So it's kind of a, if I may use the word, nationalization of investments that is happening now in India, which is, the dependence on foreign investors is going down.
Okay, yeah. What are the big ones we should look forward to? I remember LG, right? LG is going to come, and HDB Financial. Any other marquee IPOs we should look forward to?
No, I think quite a few, Lata. My view is, I think a big chunk of the internet companies which have raised a lot of private equity and will look to exit. And not a lot of them will have to make sure that their business model pivots into something which is more profitable and growing. But a good chunk of IPOs in the coming year will be coming from these new age companies. B, I think manufacturing is another big area where I believe that there could be a lot of fundraising coming in, and consumer and healthcare will be another area that is where we see a lot of fundraising happening without getting into specific names.
Okay. One of the complaints of the IPO season that's just gone by and which is underway is that most of it is, for PE funds and promoters to cash out. We haven't seen too many. I mean, there have been exceptions. Even this week, there was an exception of people raising money for expansion. Would you see that as a negative?
I think most of the businesses, the way I think about this is, if a business needs a lot of capital, which is always dependent upon external investors, it's obviously a cash-hungry business. There used to be a time when there was a lot of preference for primary issuances and not for secondary issuances or offer for sales. But I think the investors are starting to think that if the businesses are cash hungry businesses, they are not necessarily generating profits or not generating cash flows. So rather to invest in a company which is doing an OFS, which is a cash generating business, rather than investing in a company which is only kind of taking up cash. But I see the question that you have is more around the expansion and the project expansion that we would have. I think we are expecting more and more of the fundraisers to happen going forward, which will be for expansion. More around the manufacturing space. Most of the other businesses and the financials, of course, there'll be a lot of primary issuances around that. Most of the other businesses, we are looking at companies who are absolutely fantastic businesses, throwing cash, generating profits. They don't need to really need to raise capital. And if they're doing an IPO more for, for other reasons which are beneficial from a strategic standpoint from the company, I think, investors love lapping up them too.
Yep. No, I'm sorry. We are getting close to the market opening time. Bhavish, it's a pleasure having you with us. Thank you very much. And for all the key takeaways from the conversation, the IPO boom is likely to continue. We're getting the Bajaj Auto sales numbers as well. It's flashing for you on the screen. But before that, let's just get the 9-10 calls going so that our technical advisors can get back to their day. Sudarshan, the 9-10 call?
Well, consider buying Escorts. Escorts is a buy with an initial stop under 32.50.
Okay. Mitesh, your 9-10 call?
Balakrishna Industries, that's a buy for targets of 29.95.
Okay. Thanks a lot for that. We'll keep coming back to you all, of course, later on in the day. For the moment, the Bajaj Auto sales numbers are not looking spectacular. Three-wheeler is good and the exports are good. But looks like the other December auto sales numbers are not. Oh, there comes the Escorts numbers. Again, that's a bit disappointing. I mean, this is a year-on-year comparison.
So Bajaj Auto's total sales are down 1% year-on-year at 3.23 lakh. It's lower than the CNBC-TV18 poll of 3.5 lakh units. So a miss on Bajaj Auto. Even for Escorts, the total sales are down a little more than 10% on a year-on-year basis. We'll get to the details of these, but for now, it's over to Vinny for Indigo and oil marketing companies.
Good morning. Yes, keeping an eye out on both these, the aviation space as well as OMCs. Now, aviation space, why? ATF prices have been cut by 1,400 rupees per kiloliter. This is in Delhi. So the new price of ATF prices in Delhi is 90,455 rupees approximately. Even ATF prices in Mumbai have been cut by around 1,349 and the new price now is around 84,511 per kiloliter. Do not forget that for aviation companies, this is important because major raw material is fuel, which is around 40% of their cost. So big amount comes in from this front. OMCs, why are we keeping an eye on this? Because the 19 kg LPG cylinder gas prices, they have been cut by 14.5 to 1,804 rupees. And this is in Delhi. So a bit of a negative for OMCs, while ATF price cuts is a positive for aviation stocks. So that is why keeping an eye out on both these sectors.
Okay. Thanks a lot for that, Vinny. Let's also get to, okay, we have the Indian market ended with fairly good gains on the real estate space. So Nimesh is here to tell us more, is it?
No, I think we've got Winnie still with us for an update on real estate.
Absolutely. So we have the update coming in from Antique this morning. They've said that the Q3 sales booking may remain quite muted for AB Realty, Prestige Estate, Shobha, Suntech Realty as well as Kolte Patil. In the brokerage note, they're also highlighting that the Q3 sales booking are expected to remain muted. Why? Because they're expecting limited or lack of new launches. So that is something that could be impacting there. Now, in terms of numbers which are expected to do well and companies which are expected to do well, one is Godrej Properties, Macrotech Developers, DLF, Oberoi Realty as well as Brigade is expected to post good set of numbers. Antique is highlighting that Q4 FY25, they're expecting to see a surge in coming in terms of launches from AB Realty, Prestige as well as Sobha, and they believe that they're quite optimistic in terms of the real estate players that will be able to launch the remaining project pipelines that they have in Q4. So that is something that they're watching out for. Top picks being Oberoi Realty for Antique as well as AB Realty, and that is why we're keeping an eye out on both these stocks.
Okay, thanks a lot for that, Vinny. That's helpful. Antique is still positive on most of those real estate stocks, as you can see. We're just counting down for the market opening. It's not giving us any cue, the pre-opening rates. They are like kind of all over the place. The sensex up about 0.1 and the nifty flat as flat can get. But there goes the bell. And the first rates for 2025 are absolutely in the green. It's only 0.1%, but nevertheless important. And the Nifty Bank is the one that's a slightly bigger shade of green. Let's look at stocks that are doing well this morning. Well, Apollo Hospital, Adani Enterprises, Bajaj Finance, ITC. Those are the stocks which are starting with a mild green tick. I mean, it's just about 0.4. I guess the market is really looking for cues at this point in time. So no major cues, but Bajaj Auto, of course, has got the cue. The December sales are a little less than what the street was anticipating, less than the CNBC-TV18 poll. We were expecting a 3.5% jump. What we've got is a mild downtick in December sales year on year. So that's 2.4% down. Adani Ports a little bit has taken off, down about 0.6. ONGC, HDFC Life, Tech Mahindra, Britannia, all those stocks down just a smidge. I mean, you can hardly call it down. It's about 0.5% to 0.3% down on those stocks. Mid caps, any standouts?
Escorts, let's pull that up because the total sales have fallen by 10% on a year-on-year basis in the month of December. And year-to-date, which is April to December, also total sales are down close to about 0.9%. And Escorts is open with a cut of about 2.7%. So we'll watch for the tractor sales from Mahindra and Mahindra too. M&M, to begin with, is on the back foot right now, and that's down close to about 0.5%. Outside of that, watch for Swiggy as well as Zomato, because as Vinny was saying, the New Year Eve orders were through the roof. They surpassed all previous peaks seen during the festivities. But the stocks have opened flat considering the kind of up move that we've already seen. But the news there is positive. Well, in terms of, it's very, very quiet, but in terms of some volume traded stocks, Vodafone Idea, but that's, flattish. Sagility is down close to about 4%. Easy Trip is still not having an easy ride. On day one, it's down nearly about 0.5%. SJVN, where they've entered into an MOU for nearly 10,000 crore rupees with the Bihar government. That's opened up with some strength. MobiKwik has a gain of close to about 3%. Suzlon is higher in trade. Travel-related stocks. So Late Travenues Tech, I think it's called Ixigo, in terms of the platform that you would commonly use. That's up close to about 3.7%. Greaves Cotton, Rights, GMR Power, Dam Capital, Z Entertainment, Bajaj Hindustan, IREDA, where the disbursement numbers are out. These are some of the winners on day one. But very, very quiet. You'd be hard-pressed to find stocks moving more than about 1-2% on either side.
Yes, that's true. It's rather a flattish market. The rupees also opened lower. And it's drifting lower. It opened at about 62, 85.62, and it's gone down now to 85.65. So those are the minor cues that we have to work with on a day when the world has decided to celebrate, but India has decided to work. Let's do one thing. Let's invite our market master for the outlook. Okay, do we already have Samir Arora with us?
No, we have actually Nimesh, because remember that comprehensive CNBC-TV18 poll going, in terms of the outlook. So 2024, we know, ended with positive returns, about 8 to 9% on the headline indices, but about 23-24% for the mid and small caps. But the big question is, what's in store for us for 2025? Nimesh has done the most comprehensive market poll, and he joins in to give us the answers. Nimesh.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways. The highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the macro, the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well? Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Okay, Nimesh, thank you so much for being up to the button early in the morning and giving us the results of your 2024 poll. Let's welcome our market master to analyze this and give us the Outlook 2025. Samir Arora, founder and fund manager at Helios Capital, joins us. Samir, first up, a brilliant 2025 to you from all of us here.
Thank you very much. And Happy New Year to you and Rima and all the people watching and everybody at CNBC and otherwise, all the Indians, of course.
Hey, nice to see you in the pink of health, Samir Arora.
I have to be colorful on day one because day one sets the tone.
You bet. Actually, if you looked at Nimesh's poll, clearly the market is going with what didn't perform this year should perform in 2025. Even the Dow, as Rima and I were discussing, Dow did only 12%, NASDAQ did 28% in 2024. And likewise here, the Nifty didn't do well, but mid-caps have done 26 to 30%. Do you think that trend continues, that we are not going to see the big boys, do so much?
So for me, the model, and actually for everybody, it should be like that. And maybe it is that you take it from different pockets. You buy some stocks because they are growing well, but they have also performing well in the market, and some which are doing well, but are cheap or value. And it is that combo of, buying some financials and some of these high growth stocks that you're talking about, these food delivery or otherwise, or whatever be the new growth. Also, if you look at the FIIs, it looks as if FIIs are selling, but they are effectively selling their current holdings and buying into IPOs and QIPs, which means they are also, in some sense, changing their portfolio from some of the older names that they may be having in consumer and auto and others, and buying into these new IPOs, which are at least many of them or some of them are offering high growth. So there is no point in ever talking about absolutely one or the other. Of course, you can have groups of sectors doing well and expectations of groups of sectors doing badly, but there is no overdoing anyone, I would say, because you really never know what fancy the market takes.
No, I agree. But, you're a veteran of, how many cycles in the market? Probably 30 years. So at this juncture, bhagta hua ghode ke piche hi bhago, EMS, e-commerce types, mid caps. Yeah, put a larger share in the one that did not perform, HDFC Bank. I mean, you can't complain about the quality of some of these stocks, but not their best year.
So that's why we have, I think, a good description of these. One, which is what we call high confidence in reasonable return, which is these HDFC Bank or ICICI Bank or these big IT companies. You're not expecting to make 20-25% return, but you hope to make in high double digits, maybe 15, 17, 14, depending on the market. And you have more money than otherwise. And then you have these smaller, newer, faster growing where you keep a limit on each stock and you diversify across the different themes and have maybe, in our case, maybe around 15, 18%, but that also in 5-6 stocks. And it is that combo which lets us sleep every day without overly one. If you say you have to make only one investment and that one investment is the marginal new investment, then also there's an easy answer. It depends on what you don't have. If you are too much in small and mid cap, then it is better for you to buy a large cap, stabler stock. And if you are only into the old stodgy companies, even though they are promising to be okay, you need a bit of variety and a bit of higher growth, higher risk. I think it's, in the end, portfolio construction adds at least a few percentage points. Because I'm a fund manager more than an analyst, and I always say that construction has helped us. Otherwise, investors will come in to me and say, all my analysts are responsible for my performance. I say yes, but there was also this construction bit which I did. So I would suggest to everybody, you cannot.
So talking about your construction, Samir, hi, good morning, Rima here. You're saying only 15 to 18% of your portfolio would be in some of these smaller, faster growing companies, while 85 to 90% or whatever, 80-90% would be in these large cap HDFC type bank. Okay.
No, the larger, well-known, these compounder names that were given, which spoiled their compounding immediately when that name was given, those are 50-60%. Okay. These 18-20% are these super high growth guys, which are these 25-30% and growing also, but making losses, maybe all these Paytm, Swiggy, Zomato types. And you still have a third group. No, these are the groups where you are discovering new companies and they might be a little valued a little cheaply, or their growth is a little high, but you're not expecting them to make 25 and 30% for 4-5 years. This could be Indigene types or these smaller hotels or something, which are not also super well known, not super well ready in terms of quality and history, but they are promising. And we are trying to discover some of them. So there are sort of.
Do you want to tell us some of these stocks that you are discovering?
No,
like Indigene is one.
Yeah. Anymore, because now we are also separately in the mutual fund business. So you can see 100% of the portfolio every year, including the changes that the Indian guys make. And broadly, although I manage an offshore fund, because the research is common, many of these names will be there. But so you can see all of them itself. There's nothing for me to highlight here separately.
Okay, clearly since you manage global money as well, Samir, is there any chance of a global accident? I mean, not like the Lehman variety, but minor accidents like, SVB or something, which takes away 10-20%, because we have a president who can do extreme things coming on Jan 20th.
Yeah, so right now the bet is that he will not. So first, let me talk about the US a little bit, global a little bit. People talk that the US market has gone up a lot. Actually, maybe 15 stocks have gone up a lot. And if you look then this year the S&P's returns 50% are from 7 stocks. So therefore, if you see the Russell 2000, which is like the mid cap index, or you see the S&P equal weight index, where all these guys are getting extra weight, the returns over the last 5 years are 9-10% per annum, which may be considered good in dollar terms, but they are not wild. And those 15 stocks, which includes these 7 that everybody talks about, even more, you could go Spotify, Netflix, all these which have done very well. Those stocks separately look very, very good. We have nearly all of them except Apple, and they look very good separately. So the thing is, there may be an accident driven maybe by some policy thing, but I would think there is one risk, which big picture is considered positive, but in the small picture may be negative, which is that if really the US, because of Elon Musk and Vivek Ramaswamy and all, really are able to convince the US system to cut costs on government waste and all that. Now, that is a big part of the growth of the economy in the last few years, because the government spending, government deficit, all has led to this growth. And so if you cut that, big picture, it is supposed to be positive that government deficits are being brought under control and you are making the overall deficit sustainable. But it can lead. Now, but my hope is that these things don't happen immediately. These things are not as straightforward as Trump signed some tariff things. But by the way, separately, I think that from an India point of view, I think India has to make peace with China. I think India, for its growth, needs to not think that we are not going to let the Chinese in, we are going to compete with them. They are so far ahead in many things that there should be no fight on those points, because we have already lost those battles. We should let them in on EV, let them in on solar, do joint ventures, give control to whoever, whatever the rule is, or whatever works for both the parties. But you can't say we will discover and reinvent the wheel because we won't let these guys even send their employees here. I think that is overdoing it, because that would be a waste of many years of the lives of India.
Okay.
Got that. So Samir, you spoke about that, how FIIs may not be putting money in the secondary market, but they are in the Indian equity market by participating in IPOs, QIPs, etc., in the other forms of fundraise that is taking place. Is there any more nuance to this? Is there a preference that FIIs are gravitating towards? Have you done any analysis on this?
No. So my big, I don't do all this analysis. I just interpret other people's analysis. But big picture, out of the 20 odd years, if you see all this data, there are only 4 actual calendar years in which the FIs have been negative. Okay. Now this year you can say they are sort of break even on an aggregate basis, adding both primary and secondary. But you can draw this conclusion that the stocks and the sectors that they are liking now in terms of is basically what I was saying, that diversify a little bit away from the old sectors to a little bit to the new sectors. So that is one big picture. But second is not to think in absolute that the FIIs are writing off India and selling India, because as you can see in the percentage years, you can see it in the years in which their flows are negative, that you can attribute it to something specific. In 22, the interest rates were hiked from whatever 0.5 to 5%, and there was a war. In 18, we had this crisis. In 13, it was that, then before Raghuram Rajan came, whatever the
taper tantrum.
28% or whatever, 19%, and the market fell 28%. And then one was 2008. So to take those 4 years and say, oh, FIIs, will they buy or not buy? Mostly you have to assume they will buy, mostly. Then if there's something specific, then they will not buy. But this year, because of a massive shift towards US, because of Trump victory, which clearly on the margin made money move there, and the currency dollar strengthening and all that, should not be taken as that every year on first day you say, will they buy or not buy? First day you broadly say they will buy, and then let's see whether they buy or not. Unless, of course, something specific which is negative, the general tendency would be to buy.
Got that. Samir Arora, always a pleasure having you with us, and particularly happy that you joined us on the first day of 2025. Have a brilliant one yourself.
Thank you very much.
Okay, from one market master to another, we also have Sunil Singhania, founder of Abacus Asset Management, with us. Sunil, good morning. Thank you once again for not letting the hangover get the better of you and be with us. Very happy 2025 to you from all of us here.
Good morning and great wishes for a great 25 to you and all viewers of CNBC-TV18.
Well, they'll be particularly happy to get it from a fund manager like you, Sunil. Okay, well, for starters, I mean, the same question that I asked Samir Arora as well. What is the philosophy a stock picker should assume? Bhagta hua ghoda ki piche, the one that's already performing for us, the EMSs, the e-commerce, the mid-caps, or do you go to the one that did not perform, the HDFC banks, ICICI banks, Reliances of the world?
So, I think the last 4-5 years have been pretty good data for all investors, and obviously the returns have been outsized, and obviously stocks which were like the obvious ones have not performed as well, but obviously the broader markets has done much better. 24 also is similar. If you actually see Nifty has been more or less like 10-11% in terms of returns for the calendar year, though the broader markets have returned anywhere between 20 to 30%. I think going forward it's going to be a little bit of a challenge. We're already seeing that, and as you rightly said, there is a lot of momentum in the so-called narrative themes, and maybe rightly so because they have growth. However, as value conscious and more fundamental long-term driven investors, we are sticking to stocks where valuations at least have certain growth which you are able to build in, and valuations at any price obviously has not been our strategy. So it's going to be a challenging year ahead, though we remain optimistic. And I think as long as we as well as investors are happy with decent mid-teen kind of returns, I think we will follow our same strategy of focusing on fundamentals.
But it's going to be a challenging year, and making those 10-15% kind of returns, according to you, Sunil, is not going to be easy. So how would you construct your portfolio? What would be the advice? What would be the mistakes to avoid this time? And also, do you think earnings will make a comeback?
So on the second question, first, I'm very sure that earnings will come back. Obviously, December will be slightly better than September. But we do expect, the March quarter onwards earning to trend back to the double-digit growth. If that doesn't happen, then India does not qualify to be a growth market and will not obviously attract the kind of P multiples which it has been. But we are quite hopeful with the government spending coming back, monsoons good, and the festive season as well as the wedding season in full swing. I think from now to June, which is pre-monsoon, activity should really pick up, and so would be the earnings. On your first question, actually, what typically happens is that obviously everyone likes momentum and everyone likes to be in stocks which are moving. And what has happened over the last, obviously, 6-12 months is that the segments which were mentioned, like EMS, to some extent, even the narrative sectors like defense, railways, after a big jump, they have sort of slowed down a little bit, but there is still interest. And there is this segment, I call it, the market cap from 101 to 250. I think that is the most overpriced segment of the market, and largely because mutual funds which are mid-caps have to compulsorily invest in that segment. And there are good stocks there, but if you see the valuation, nothing is below 60-70 PE there. So I think there is a sort of a issue of money coming in, and therefore funds having to buy the stock. And obviously when momentum is there and the price keeps on moving, the others are forced to invest in that. So I think it's going to be a tough time sort of resisting stocks which are moving up. At the same time, valuations at some point of time will start bearing on the stock price movements.
So since stocks where the market capitalization, if you rate it from highest to lowest, between 100 to 250 you're saying is highest, where we've seen maximum exuberance and valuations, etc. So would you bet with large caps and even small caps then?
So I think the good thing about India is that we have so many listed companies, and though our view is that IPOs are significantly overpriced, there are some decent companies which are also going to be listed over a period of time, which are already listed and going to be listed over a period of time. And as a portfolio manager, all you need is, maybe 5, 6, 7 good picks in a year, the new ones, and you are home. And I think with this large number of companies which are listed and the markets as well as the economic environment being so dynamic, from time to time one ends up, finding a few bets which you can look out for. So I think at this point of time, what we are trying to do is in our funds, which are like we have an all-cap fund, which is more a mix of large and mid. We have increased our weightage slightly to the large cap. On the other hand, we have a pure mid and small cap fund. There we are 100% mid and small cap. But I think what we're trying to do is shift towards companies where earnings are a little bit more visible and more sustainable in the near term also. So our experience over the last 6 months has been that when the markets have also been a little bit challenging, companies which have demonstrated resilience as far as earnings have ended up doing much, much better than otherwise. And I think a little bit of more focus on near-term earnings is also what we are more concentrating on.
Sunil, interesting you mentioned that IPOs made money, but you're saying that many were overvalued. Money Control did a study and 60% of the IPOs are actually even now making money for the investors. Of course, some of them are outstanding, like the Jyoti CNC. I think it was 300% or something above issue price. You don't think the IPO market is frothy, is it? You're saying that people are getting away with unreasonable valuation?
So I think right now the interest level is like crazy. And when interest levels are such crazy, you obviously will have in the near term, pricing also reflecting that. But, we are not here from a 3-6 months perspective, I think we have still not seen a major drawdown as far as the broader markets are concerned. The markets have been flattish last 6 months on the Nifty, but broader markets have been, I would say, pretty decent. I think once the valuations start to reflect the reality, that is when some of these companies, at least as stocks, would face a challenge. And the other thing is, Lata, what happens is when a company comes in for IPO, obviously there is a very limited history of performance in various cycles. And one is relying completely on the guidance given from a next 2-3 years perspective from the investment bankers and management, and no one gives negative guidance. Everyone's guidance is superb. So a company which has made 100 crores over the last 20 years cumulatively is expected to make a profit of 400 crores in the next 2 years. And you are willing to give the benefit of doubt till it comes. So I think let the result season start for these companies in the next 1 or 2 years. We'll know, how many of them end up doing better. But as I said, there are definitely good companies which are hitting the market. And there are companies which are maybe good but overpriced, and then there's a third lot which are not good and overpriced. So one has to be careful about the 3 buckets.
Yeah, absolutely. Sunil, tell us what could be the red flags that you would watch out for? I mean, not a worst case, but likely red flags.
So the good thing is that India still stands out. I am very sure that we will head back to the 6.5% growth rate. Obviously, Trump coming in will lead to a little bit of rhetorics. Obviously, he's known to speak a lot, but every politician speaks a lot, and not everything what they speak ultimately gets implemented. So once he takes power, who comes to power, we will see what happens. But we are already seeing some movement on the currency side. Indian rupee has been resilient but still depreciated by 2.5-3% over the last couple of months. I think that movement has to be watched very carefully, because depreciating money will push back maybe the likely FI inflows which we are expecting in 25. The other red flag is purely earnings. I think as long as corporate India keeps on reporting earnings which are 12 to 15% year-on-year growth, I think the macro are pretty decent. We are heading to the next 4 years, 5 years of this new government. Hopefully the budget will be pro-growth, which always happens in the first 2-3 years of a new term. We have decent foreign exchange reserves. I think there is a lot of government spending which is lined up. Companies are quite optimistic. And we are also coming out of maybe a 12-15 months of a lull as far as consumer spending is concerned, and that should also come back. So I think we are heading to a nice 2-3 year setup. I think the only thing we need is the corporate profit to come back. And that also hopefully from March will come back. From a global front, as I said, rhetorics and talks would maybe cause near-term ups and downs, but I don't see a major issue even there.
But doesn't it worry you that urban consumption has been falling? I mean, not just the warning from Godrej. Did you just see the Bajaj auto sales also down, about 1.5% year on year? Will that not be an issue?
So, there are segments, obviously real estate, everyone was selling apartments in Bombay at 1 lakh and 1,50,000 rupees a square feet. Now there are only that many, Indians would be able to afford those kind of apartments. And suddenly, you have buildings coming in left, right and center. Everyone is going in for redevelopment. And there is going to be a lull at some point of time, though we are quite optimistic about the real estate sales, but I don't think prices can go further from here. As far as auto is concerned, I think auto in India, two-wheelers and four-wheelers on the passenger side, has never seen volume growth consistently of more than 5-6% year on year. So I think it's not a surprise. And the other thing which you have not to forget is that the number of players are increasing. So maybe the volume overall is growing at 5-6%, but the listed guys are not able to retain their market share, which is happening in a lot of places. I was speaking to a major tile company, and this is the segment is growing, but there are new players coming in from Morbi who are now selling in their own brands. So it is getting a little bit more competitive, and I think that is going to be the case. I think one thing which we should not forget, Lata, is that capital has been available in plenty, and hopefully that will be available in plenty. Now, capital raising is good for the companies, but we also have to not forget that it breeds competition. Because if a company is able to raise 1,000, 2,000 crores of capital, the ability of that company to compete with existing players increases quite meaningfully. And we are heading into a phase where maybe the ROEs, which was 17-18% for Indian corporates on a consistent basis, might fall to maybe more around 15-16%.
Okay.
That's a good point. Thank you, Sunil, for joining in. So this capital breeds competition, and that could be a risk for some of these existing companies.
And not just that, I think, Sunil, it was such a beautiful 180-degree perspective on sectors, competition, unlisted competition, the India growth. Thank you very much for giving us such a nice wrap to step into 2025 with enough perspective and the optimism that India is a growth story. Thank you very much for joining us on Outlook 2025.
Get into a break. On the other side, we'll be joined by B. Bhaskar Rao of KIMS Hospital to talk about the next year. This year. Stay tuned. Welcome back. 70 points down now on the Nifty. At the index level, it's 1/3 of a percentage point lower at the day's low. Banks are under pressure. ICICI Bank in particular is down over 1%. The Nifty Bank is down close to about 400 points. And Bajaj Auto continues to remain the top Nifty loser today on the back of disappointing December auto sales numbers, even though the company is doing very well on the electric two-wheeler side. But in terms of the pure, sales, auto sales, it's been a rough month. Sales are down 1%. But it's time now to get KIMS Hospital, that's the next management on the show, to talk about the business outlook and the key growth drivers going ahead. We have with us B. Bhaskar Rao, Chairman and Managing Director of the hospital with us. Thank you very much, sir, for joining in. So it took you about 4 years to double your revenues from 1,000 in 2020 to about 2,000 as of 2024. When do you think you will be able to double the revenues from 2,000 to 4,000? And what would be the key drivers to your mind?
So our expectation will be around in next 2 to 3 years, it will be doubled. The reason is we are doing more expansions, and nearly this year we are expecting around nearly 2,000 beds are going to come to operational. These are all, most of them are in metro, in Bombay and Bangalore. There looks like very high ARPOPs. With that, the revenue ramping up will be much faster than compared to the previous 4 years, because we were doing all these years in the tier 2 cities. Now in the metros, the RPOPs are more. So we are very confident that it can be doubled in 2 to 3 years max.
Okay.
And so this beds, you said 2,000 beds will be added this year in 2025, FY26.
Yes.
What
correct.
about, have you made long-term plans in terms of further expansion into metro cities or the number of beds that you would like to achieve eventually?
In the next 5 to 6 years, we are planning to total from including these 2,000s this year. We'll be adding around nearly 6,000 beds, which comes out to be 10,000 in total by Kim's Group.
Okay. That's an ambitious plan. But let me get to the immediate year. So you said that you're going to add in the metros and therefore it won't be margin dilutive. You've been doing good margins. The last one was 25.6%. In fact, H1 you did 27%. You'll be able to maintain that, or will at least in FY26 the margins fall because of the fresh capex?
The way we are looking at the margins may not able to fall, because the type of consultants we are going to tie up and already is going, maybe 1% or 2% short term, 1 or 2 quarters it may go down, but on the whole it will be able to sustain the margins.
Okay. So what is your expected RBOP, the average revenue per bed from the, from Maharashtra, Karnataka, your metro cities versus your current RBOP?
See, in metros in Maharashtra, first time we are entering into Bombay, they are all looking into other competitors are doing around 3.5 to 4 crores RPOPs. We may be always little down than compared to others, as we would like to keep that competitive, not competitive, to provide to good healthcare at an affordable cost. Even Bangalore is also better than Hyderabad. Today in our group, we have the highest RPOPs are in Hyderabad city, whereas in Andhra, their all RPOPs are very, very low. So with these two adding up Bangalore and Bombay, I think the RPOPs increases and the margins also will increase there.
Okay, well, I think we have to explain to everybody who is not in the hospital business that RPOB, a word which we've been using, is average revenue per occupied bed. So that's an improvement which helps hospitals, but too much of that hurts customers, hurts patients. But you all have had a lot of revenue coming in from Telangana, I believe 47%. Are the margins still good there? Will you see yourself being more of a non-Telangana player? What will that do to revenues and margins?
So as of now, the margins are good in Telangana, and as well as the whatever margins historically we are showing in Andhra Pradesh, that is also there. Even if you go to other states, the margins will be definitely better than Telangana. That's what even the present market showing there in those areas.
Are your occupancy levels, Mr. Rao? Percentage?
Right now, I think we are, because we keep adding about 60-65% on the beds in total. If it is a operational beds, we are around 70-75%. Whenever there is a need, we keep on improving because the entire capex has been kept for all those 100% beds. But whenever there is a need, we just only add a few more nursing staff and other staff that will able to. We have still a lot more growth in the existing, that is in Telangana and Andhra. And moving forward, because the Bangalore and Maharashtra is coming, on the whole group level, the occupancy rates may come down for a 2-3 quarters, because initially any hospital will take about 3-4 quarters to build up. By the time once it comes to in 4 quarters, again we'll be able to pick up the occupancy rates to what it is in the present scenario.
Yeah, that's why analysts were asking us to ask you about whether margins will fall below the 27% mark. Now, can you also tell us how long does it take to break even? For instance, your Nashik hospital, that's new. How long will it take to break even? Typically, how long does a hospital?
2 to 3 quarters max, the break-even point comes.
Okay.
Sir,
in even the same Bangalore and Bombay also, we are thinking around only 3 quarters max.
Oh. 3 quarters. So since you do have plans to get to 10,000 beds in totality in the next 5 to 6 years from the current 4,000, would you be making acquisitions also?
See, mostly we are looking for a brownfield, semi-brownfield that is already running hospitals where they need our help. We are trying to acquire those things. And few already started as a greenfield projects, like all these three are Bombay and Bangalore are greenfield projects. Most of the Kerala projects are all brownfield as of now. Maybe we'll get one or two. That's why we have talked about next 5 to 6 years. This 10,000 beds is a mixture of brownfield, M&As, and as well as the greenfield projects.
Will you require any fundraise, a capital raise?
So we have been seeing that next this beds, I don't think we may require any fundraise. Our internal accruals itself will be able to resolve, and the only thing is maybe 1 or 2 quarters we will be able to touch to EBITDA to 1:2. Debt to EBITDA is 1:2. We would love to keep it at 1:1.5. That is our goal. We will definitely will not cross that, but sometimes because the opportunities are there, instead of raising the funds, maybe 2-3 quarters it will go up to 1:2 EBITDA debt ratio.
Okay. All right, Mr. Rao, we'll leave it at that. It was a pleasure speaking to you. Thank you very much for joining us. And let's hope you and everyone at KIMS have a great 2025.
Thank you. Wish you the same. Thank you.
Okay, so that's the word coming in from a hospital company that things are looking good and they're going to expand rather aggressively, I would say. A 2,000 odd bed hospital now getting into 4,000 in probably the next couple of years and aiming at 10,000 beds. With that, let's take a look at the markets. We haven't done that in a bit, and it's the Nifty Bank, which is still struggling. The others are still down, but 0.25%. Nifty Bank is down 0.5%.
Mitesh is now with us for a few technical trading strategies. Hi, Mitesh. Sluggish, but with a downward bias.
So, again, the idea was that if we break 23, 550, 560 zone, there was chance of a breakdown. The bank Nifty, it was about 50,500. The low for the Nifty is 23,560 and the low for the bank Nifty is about 54.85. So I think today's low become important markers. The structure is slightly on the weaker side, but in case we can hold on to today's low, then I think there can be a pullback on the half-hourly, hourly chart. So that could keep the market slightly healthier. But in case we see breakdowns, then I think we'll look at declining continuation, and then especially on the bank Nifty, a close below 50,500 450 zones would suggest a further correction of at least 1,000 points. I suspect could be more, but that's the minimum which I'm looking at. So the structures, we keep cautious, and I think keep monitoring today's low, I think, as important market levels. On the stock side, I have a buy on Muthoot Finance with the stop at about 21.29, just below 21.30, and look for a target of 22.50 here. While a sell on Apollo Tires, I think that's something which is weakening. So sell on Apollo Tires with a stop at about 531 for targets of 505.
Okay. This week we have seen some big losses in Sagility. Of course, that's a new stock. Any of the metal stocks would you trade? NMDC's seen a bit of a bad week, about 6% down. Hindalco is down about 3.3. Do any of these interest you at all? Because in the morning you started off with a set of short trades. Are these lending to short trades?
The metal pack, has been weak for quite some days. In fact, if you look at NMDC, if you look at the last few days of price movement, after making a high of around 80.81, since the 12th of December, we have seen the stock price come down to 66. It's still weak, and for me, I think that's the case with most of the metal stocks. But given the fact that they've had some correction, here I would at least want to see some bounce back. So my entry point gives me a slightly better risk-reward equation.
Okay.
Thank you very much for joining in. Let's get to the next corporate on our show then. Mazgaon Dock Shipbuilders. Just 2 days back, the company signed a 990 crore rupee order with the Ministry of Defence for the construction of units that allow submarines to stay underwater for longer. Sanjeev Singhal, Chairman Managing Director of the company, is with us on the show. Thank you very much and Happy New Year to you. First, if you could give us details about this order and the execution timeline.
Yeah, as far as the AIP plug is concerned, this has been developed by DRDO, but considering that MDL has constructed the Scorpion submarines, we have already delivered 5. The 6th one we are about to deliver, and we are likely to get another contract for 3 more Scorpion submarines. So these are this AIP plug is to be fitted in the existing conventional submarines, whereby the submarine is cut open. This plug is approximately 10 meter in length. So this plug is inserted in between and the submarine is welded again. So it becomes a much longer submarine, and it provides the capability to the submarine to remain in under submerged in water for 2 to 3 weeks. So this is a very huge capability enhancement for a conventional submarine. Considering that we are talking of 9 submarines of Scorpion makes 6 as per the current order and 3 more which we are expecting soon. So this AIP plug would be sequentially fitted in almost all the submarines depending upon the success of the first project. So we expect a very healthy pipeline going ahead with respect to retrofitting of this AIP plug in the conventional submarines.
Okay, got that. Understood about submarines. Can you give us an update on your current order book? Out of this, what is your order book that will be for exports? And seasonally, since H2 is usually better for you than H1, what is the order inflow target that you have set for the second half?
As far as my order book is concerned, as on 30th of September, we are around 38,000 crores. Of course, the third quarter figures are still under finalization. So a better view would be available in a couple of days from now. Going ahead, as I said, we are expecting a significantly large value order in the form of 3 number of Scorpion submarines, which is a follow-on order for the 6 submarines which we are currently executing. 5 we have already delivered, and the 6th one is almost on the final leg of delivery. So we are expecting the delivery within the month of January.
Got that. So talking about your revenue, now Q2 was strong, 51% top line growth, the highest that we've seen in the last 5 quarters. Is that solely because of seasonality? Were there any other factors? And what's the outlook for the second half of the year? Do you think you could end with the highest ever revenue growth or numbers this year?
As far as 24-25 is concerned, we are expecting a growth of around 10 to 12% over last year. And going ahead also for FY26 also we are expecting a similar kind of a growth. But at the same time, as far as our projects are concerned, we were running 3 projects parallelly, Scorpion submarines P75, the 15 Bravo destroyers, 4 in numbers, and 17 Alpha frigates, 4 in numbers. So as far as 15 Bravo destroyers are concerned, we have completed this project in the form of the last delivery. Of course, certain liabilities are pending and B&D spares, which we will be supplying over next 4 to 6 quarters. 17 Alpha is progressing. We have delivered the first vessel of 17 Alpha. Balance 3 vessels will be delivered over next 2.5 to 3 years. And project 75, which is 6 number of Scorpion submarines, we have already delivered 5, and we are on the verge of delivery of the 6th submarine. And moving ahead, we are looking forward for 3 more submarines of the same projects, follow-on submarines. So this should be giving us a continuous pipeline of projects and executions. So we don't, moving ahead for this year as well as for next year, we are expecting something between 10 to 12%, 13% growth.
Okay. Well, now let's come to your margins. You had guided for a 10 to 12% EBITDA margin range for FY25, but brokers are expecting the higher margin to sustain even going forward. That is actually for the next 2 years, FY27, because major deliveries are planned over the next 2 to 3 years. Where do you see margins after this year, after FY25? And also, are you sticking to the FY25 guidance?
I have been maintaining and I continue to maintain that as far as this industry is concerned, a 12 to 15% margin is a very healthy margin. There has been a certain uptick in our margins in recent years, primarily because these are very long gestation projects and the margins are based on the projection with respect to cost to completion. So when the project is not fairly mature, it is difficult to estimate accurately the cost to completion. As we move deeper into the project, a more accurate assessment with respect to cost to completion is available. In addition, there have been certain refunds with respect to the liquidated damages on the Scorpion submarines which were deducted earlier. I think we have already received 3 refunds. One more has been sanctioned very recently. The 4 LD refunds, these have also contributed quite substantially to the bottom line of the company. And moving ahead, one more LD refund is under discussion with the Indian Navy. And with respect to the 6th submarine, which again would be delivered most probably in the month of January, there also the liquidated damages have been deducted. So once the delivery is completed, we would be entering into discussions with the Indian Navy with respect to ascertaining the attributability of delay. And we are quite confident that for the 6th submarine also, in due course of time, this LD refund should be coming to MDA. So all these things would also be contributing to the profitability of the company.
Okay. So can you give us an update on your P75I orders? Is that likely in FY26?
Yeah, as far as Project 75I is concerned, 6 number of conventional submarines with AIP and lithium-ion batteries. Here, Mazagon Shipbuilders is participating in collaboration with ThyssenKrupp, Germany. And the field evaluation trials for our submarines have been found to be successful. So technically, all the evaluations have been done. We believe that we are the only collaborators, we are the only combined MDL and TKMS whose bids have been technically found to be successful. So moving ahead, there would be commercial discussions and negotiations, and we are quite hopeful that within the next financial year, this order should materialize.
Okay, and lastly, you're targeting 3 deliveries, right, for 25 and 26. Are you on track? Any update?
As far as FY25 is concerned, we have already delivered 2 vessels, 1 destroyer and 1 frigate, and we are very much on track with respect to the 3rd delivery, that is the 6th and the last Scorpion submarine of the current project. We are targeting that this delivery should happen anytime soon in the month of January. Going ahead with respect to FY26, we expect there can be, if the year goes well, there can be 2 deliveries of frigates. Otherwise, at least 1 frigate delivery is definite.
Okay, we'll leave it at that. It was an extremely optimistic conversation to ring in the new year. Thank you very much indeed for joining us, sir. Well, that's the word coming from Mazagon Dock. Big orders and a very enthusiastic managing director out there. We have to take a break on that note, but just a word, market's still a little under the weather, you'll have to say. But what I wanted to point out was there is a bit of a recovery after the first hour of selling, especially the Nifty Bank. Okay, not just the Nifty Bank, it's more so in the Nifty and the sensex. Sensex now almost in flat terrain as the mid-caps as well. That's good to see. Advanced declines, of course, are in favor of advances. That's important to note. We'll take a break on that note, and thereafter, we're going to connect with the big man from the banking industry. That's the industry that went through a bit of a struggle as far as the markets are concerned. We will have the chairman of SBI, C.S. Sethi, joining us to discuss outlook for 2025. Welcome back. We started the morning by telling you that there are quite a few orders that have come in overnight, and one of them was for SJVN, if you remember, the power company, Satluj Jal Vidyut Nigam. Vivek is here to tell us more about SJVN.
Well, that's right. A very interesting development. Like we highlighted in the morning, this particular development stands out given the fact that the tariff that the company has mentioned as far as, the press release is concerned is quite strong. And on the back of that, you're actually seeing quite a strong up move. Also, remember, SJVN is a recent entrant as far as the F&O space is concerned. But let's have a look at what is it that the company has told the exchanges. The company has signed MOUs for multiple pump storage projects in Bihar. So the main project that the company is discussing is a project called as the Hatida Durgavati PSP. Earlier, the size of the project was expected to be close to 1600 megawatt. But after conducting the feasibility study report, the size of the project is now at 1000 megawatt, which will be 4 units of 250 megawatt each. What is it that the project cost will be? The project cost is a little over 5,660 crore. the daily peak energy is expected at 6.325 million units, which translates to an annual peak energy of close to 2,308 million units. Now, the levelized tariff that the company has indicated in the press release is that it is going to be at rupees 9.39 per kilowatt, which is based on the Feb 2024 levels. On the back of that, HJVN positive development, also given the fact that it gives visibility as far as capacity addition is concerned, you're seeing the stock do quite well in the session so far.
Yep. Thanks a lot for that. Vivek, a levelized tariff of 9 rupees is damn good, yeah, per kilowatt. Not good for consumers, though. Okay, let's get to Rima. Rima, Bajaj Auto numbers, quite a disappointment. The market's not happy.
No, so total sales are down 1.1% at 3.23 lakh units. This is lower than the CNBC-TV18 poll of 3.5 lakh units. Motorcycle sales are down 3.8%. Exports, though, continue to do well. So year on year, down 1.1%. On a month-on-month basis, you will see a sharper fall because the total sales would compare with 4.2 lakh units in the month of November. But again, it's not a fair comparison because the prior month got a festive boost. But what's interesting to note in the internals is the contribution of exports has been steadily rising. So even as domestic sales are faltering, look at the contribution of exports over the last 3 months. And now exports are nearly 50% of the domestic sales. Now, the stock is under pressure today. This year, I mean, in the last year, it's up close to about 30%, but it's still off about 32% from its peak levels. Also, we got the electric two-wheeler Vahan data. And here, Bajaj Auto is making rapid strides. It's emerged as the #1 player in electric two-wheelers with a market share of 25%, followed by TVS Motors at 23% and Ola Electric at 19%. So it's quickly displaced its peers to get the numero uno position. MK has written a note on two-wheelers where they're saying that both Hero and Bajaj have seen about a 33 and 30% fall from peak levels, and according to them, this is unwarranted. The outlook on exports is improving and poised for a sharp recovery. So that's the view coming in on MK, but today there's clearly disappointment.
Yes, and there's disappointment even from M&M in certain parts. Total auto sales is up 16%, but it's not as good as the market wanted. The CNBC-TV18 poll was expecting over 70,000 vehicles. They've done 69,000. So it's lower than the market expectation, but individual, like exports have done very well. PVs have done very well. It's per se 9% growth looks good, but looks like that the analyst community, as you can see, CNBC-TV18 poll was 71,000 units, but they've delivered 69,000. The market anyway is excited, not terribly worried about analyst expectation. Okay, with the auto sales number now, let's shift our focus to the interview of the day, of the morning. We are joined by the biggest banker of the country, C.S. Sethi, Chairman, State Bank of India, to give us an idea of Outlook 2025. Good morning, Mr. Sethi. We really appreciate you giving time for us. And here's wishing at the outset a very happy new year to you and to everyone at State Bank and your family.
Good morning, Lata. Thanks for having me on the first day of the year on your show. And it's an honor. And I wish all the viewers of CNBC TV18 a very happy new year. Along with your viewers, the whole customer universe of SBI, I wish all their families and their businesses a wonderful year ahead.
Well, 2024 was not an unkind year at all for State Bank of India. It was bad for the banking sector. Bank Nifty, I'm entirely talking from a market point of view. The Bank Nifty went up only 4%, whereas the Nifty went up 9%. But State Bank shares went up 24%. So it was an outstanding year for some of the banks. Mr. Sethi, what went so right for SBI in 2024?
Apart from the market, of course, market has took some time to recognize the potential of the stock, obviously. What we have shown our resilience and the consistency in our performance, essentially. I think it is not only in terms of the largest amount of profit among the corporates in India. We also had focused on increasing our customer offerings, number one. Number two, we continue to invest in the technology and digital adoptions. I think that also had contributed to our recognizing the value what SBI brings to the fore. The other thing is, some of the conventional business lines, what SBI has been known for, we have strengthened our focus on them, particularly on the MSME, large value agriculture, and we continue to be market leader in home loans. And more importantly, above all, I think we have demonstrated the resilience in our asset quality. I think all these things have helped us to present a good picture to the market.
Okay. Well, that's good to hear. But, you know, the big problem that bedeviled the banking sector, I mean, one of the reasons why perhaps the index itself underperformed is this desperate hunt for deposits and the rise in the costs. How do you see that panning out? Will the cost of deposits abate?
So, as I mentioned earlier also, Lata, in your show, that I think there's only so much we can compete on the interest rates. And we have to increase our customer services and in terms of value proposition, which the bank account brings or bank deposit bring to the customers. I think more importantly, the post-COVID credit growth, which was substantially high, and the deposits have not kept pace, probably had created this imbalance. If you see the November numbers, I think broadly, both the deposits and advances are coming to some equilibrium. So the renewed focus on the deposit mobilization by the banks and the balanced growth in advances, I think is helping us to set the balance in place. So I don't think there will be too much cost escalation on the deposits. Obviously, you know, all the banks are focusing on activating their networks, branch networks, and also redesigning the products and processes. How do we retain and mobilize more deposits?
Okay. Okay. So you think this, I think even SBI offered 8% product for a 1 year, FD. Is that the peak?
No, I don't think we have offered 8%, but it is our highest rate Amrit Vrishti is around 7.25%.
Okay.
So with some additional interest rate for the senior citizens.
Yes.
But I personally believe that the interest rates on the deposits have peaked.
Okay, that's good to hear from a bank investor point of view, even if it's not very good news for pensioners. But how do you see credit growth picking up? That was the other issue. Credit growth had to be brought down below deposit growth, or at least to deposit growth. Where are you seeing credit demand? Are you seeing industries, corporates hungry for credit at all?
Corporate credit growth essentially is coming from some of the sectors. Obviously, you know, the renewables, roads, some of the petrochemical expansion has also contributed to the credit growth. But I think core sectors, the capital expansion has not been happening, particularly in the steel, cement. I think there's a more of consolidation which has been happening there. Hopefully, one important thing what we noticed is the housing sector is doing well. Which means that, you know, some of these sectors like steel, cement probably would do better in the current calendar year.
Okay.
As far as renewables is concerned, I think as you have shown in your show also, that the renewables is coming across solar, hydro, pumped hydro, for instance. I think a lot of capacity additions is happening on the renewables. And the green financing probably would be more focused in the current calendar year.
Okay. So for 25, what kind of a credit growth, or even FY26, what kind of credit growth, what kind of margins, ballpark ranges?
Margins, I think, broadly would stabilize because, as I said, interest rates on the deposits have peaked. And we need to watch out on the policy rates also, how interest rates movement is going to be, behaving in the current financial year. And of course, current calendar year. My view is that I think rate cuts would be there, which means that the softening of interest rates will be there, which would spur the demand, particularly on the retail side, which was some kind of, other than housing, the other segments of retail personal was slightly slowing down. And the interest rate reduction would definitely spur the retail credit growth. As far as the corporate is concerned, the capacity utilizations are at the peak now. I think most of the sectors have reached 75% capacity utilizations. But I think external sector is making them to hold back a little on the capital expenditure. So if some clarity emerges on the external environment, I think they all will come back to the capital expansion.
Yeah, I take your point. Quite a few CEOs were saying that, uncertainty over trades, tariffs, exports is leading to perhaps, postponement of decisions. But let me come to the, micro challenges, or rather specific challenges to the banking sector. One, do you think fee income is under threat? I mean, you all made a lot of fee income because of selling insurance. Now both the insurance regulator and the banking regulator are moving to curb that. Will that be a dampener for the entire sector?
Fee income, particularly which comes from the
sale of insurance.
Cross-selling is not very significant. If you see large banks, our fee income is minuscule from coming from the cross-selling part. I'm sure, I think most of the large banks also have a lot of other income streams other than cross-selling, which is, available to us. Particularly, we have bulk income coming from the forex and treasury activities, and also from the loan processing charges. I think these other income streams will continue.
Okay. All right. I think the problem is more for SBI Life, or perhaps for all the life companies, if their parent companies are curbed from selling too much of their products. It's not your problem, it is the insurance companies' problems, right?
No, most of these insurance companies are also diversifying the way they source their business. Obviously, the agency channel is picking up across the industry. Obviously, in the initial stages, the dependence on banker will be there, but I'm sure, I think all these companies will find different ways of doing the business.
Okay. Well, there are three big overhangs on the banking sector from the regulator. One would be LCR, the other would be the project finance higher provisioning, and the LDR provisions as well. Expected loss provisions as well. Do you think FY26 will see the brunt of all these, or will they be more diluted than we think?
So we've been engaged with the regulator through various fora, especially through the IBA. We have given our views on all these three areas where the discussion papers and draft guidelines were issued. And I'm sure the regulator will relook into, some of the suggestions what we have given. So we'll have to wait. I have no view on, what is the timing and in what form it is going to come in.
We will reserve that question.
But RBI, I think the regulator would definitely consider many of the suggestions what we have given.
Okay. No, I agree with you. I'll reserve the question for the RBI governor if and when we get him. Just a final word on this unsecured loans. Both the Financial Stability Report and the previous Trends and Progress in Banking kept saying that they're worried about unsecured loans. Although GNPAs are at all-time, at 13-year lows, do you think this unsecured loan is going to give NPAs even for SBI?
If you ask me, from SBI side, we always said that our unsecured loan portfolio is completely different. In fact, we keep saying that our unsecured loan portfolio is more secured than anything. So I don't see any asset quality issues. Of course, it's not appropriate for me to talk much about that on the SBI numbers. Our silent period kicked in. But one definite development in the market is that with various measures, what RBI has taken, there is a moderation in terms of the growth of unsecured personal loans, as well as the way the unsecured personal loans are being underwritten, priced, monitored. I think there's a huge amount of work which had gone into it. So obviously, I think that would result in the better asset quality going forward.
All right. We leave it at that, sir. Thank you very much. You give us some optimism that for the banking sector, deposit costs have peaked and therefore margins, if anything, will stabilize, and you are seeing signs of credit growth. Thank you very much indeed for joining us.
Thank you, Radha.
Okay. So, well, that's setting the tone for a good 2025 from the banking sector. Quick break, and thereafter, Manisha is going to tell us about the commodity trades in 2025. Welcome back, and it's over to Manisha. Manisha, what's the big commodity of 2025 that you're tracking?
Well, it's day one. The Asian markets are just opening, and most of them are not even opening right now. But, much of the cues would come in from 2024. And, well, yes, there's a lot of uncertainties as we get into the new year as well. So one thing that I want to put on table clearly is about the dollar index. And this has been the best year since 2015 when you look at the dollar index move, which has been up by 6.5% in the previous year. And when you look at 2025, the first day that is, we are holding above 108 onto this one as well. Well, there are expectations of pro-growth, inflationary policies from Trump when it comes to taxes and tariffs, and that perhaps could keep the dollar index surging higher. We've heard a lot of experts telling us that 110, 111 is where this rally perhaps could peak out. So that is still 300 points on the higher side from here on. Well, I want to talk about the crude oil prices because we've started 2025 on a positive note. 0.25% on the higher side, but the volumes are quite thin. But when you look at 2024 and what we are carrying from that one is the fact that you've seen second year of decline in 2024. We saw the prices decline by 3% in the previous year. Also, when you look at the Chinese demand manufacturing data for the month of December has been on the positive side. Is the reason you've seen last 2 weeks actually positive for crude, and is the reason that much of the loss that we were looking at for this year seems to have gone down as well. At one point in time, we were trading 9% down on crude, but we've closed the year down by just about 3% there. Well, it's positive Chinese data has done that trick, but the markets will watch out for a lot of things in 2025. It is going to be about risk of excess supply, geopolitical tensions, Trump's oil policy, and add to that the fact that the Chinese demand is still not clear, and then you have higher supplies coming in from US and many of those non-OPEC countries as well. But within this space, it is about the US natural gas prices, which gained quite strongly. It was the best year since 2016. We've seen nearly 56% of gains come in. Today, we've seen 7% of a decline, but that's about profit taking. It's winters, January is going to be colder, and all of that perhaps will lead you to buying opportunities there. I also want to talk about precious metal prices because we've seen gold and silver actually do better than various equity indexes as well. Not so much the case for platinum and palladium, but when you look at the gold prices, this is the best year since 2010. Silver is put in the best yearly gains since 2020 as well. So it's been a good year in that sense for gold and silver prices, also given the fact that we've seen all-time highs, and you could be looking at further all-time highs in the year 2025. When it comes to the base metal prices, ferrous metals did not do well. We've seen 15% of decline in iron ore and a 22% of decline for steel. Copper, while has gained 5% for the year, but when you look at the last couple of weeks, it has continued to decline. It's trading at a 3-month lows right now, and the markets are looking at copper prices coming off 30% from its all-time high that we saw in 2024. So it's going to be tricky for metals. Buying continues in precious metals, though, is what the cue is as we step into the new year.
Okay, thank you very much for that overarching wrap, Manisha. And here's wishing you as well a great 2025 as we wind up on Bazaar. We have at least conquered the red in the market, is handing over to Chartbusters in the green. Chartbusters for you after the break.